This is Ethan, CFA Charterholder and investment professional, and today I'm going to be reviewing SVOL, the Simplified Volatility Premium ETF, which is quite possibly the best income investment I've ever seen. First, I'll explain what the VIX is, which is, of course, what this ETF is based on. Then, how SVOL generates such a consistently high income. And finally, what role it can play in a portfolio, whether you're a long-term growth investor or an income investor. Let's start it. This is an exciting one for me because I've been selling volatility with VIX ETFs for over a decade. They have been by far my most successful investments I've ever made. So if you want to understand how SVOL works, you've come to the right place. Understanding SVOL, which sells VIX futures, starts with understanding the VIX. The VIX is known as the fear index or a volatility index. Basically, it's derived from the ratio of puts to calls on the S&P 500. A put option is basically a bet on the investment to go down, and a call option is basically a bet on it to go up. So the higher the ratio of puts to calls, aka the higher ratio of people betting on the index to go down, the higher the VIX will be. So it's considered to be a volatility index, but it's not exactly measuring volatility. Volatility means movements up and down. But if the S&P 500 is just rocketing straight upward, the VIX will generally be very low, because at that point, no one is worried and betting on it to go down. So it would actually be more accurate to call it a fear index, or say it only measures expected downside volatility. You can see from the chart that it's generally low, like in the 15 or 20 range, for long periods of time, but it's prone to rapid, short-term spikes every once in a while during market turmoil, like the tech bubble, 2008, etc. The VIX is not really something tangible that you can buy. It's not a list of stocks or anything like that. You buy it through the futures market. These are the VIX futures prices as of November 8th, 2024. The November 2024 contract expires later this month and is at 1550. The December contract is priced at 1576, and so forth and so on. The actual level isn't that important. What's important to notice is how they generally go up over time. That's what's called being in contango, and it's the main reason I started buying ETFs with short volatility. The prices are generally in contango, meaning going up over time, because people are always wanting to buy VIX futures to hedge against a major market event. When the VIX spikes, pretty much everything else you own will be going down, so it's like buying insurance. People are willing to pay up for that insurance, but just like buying insurance, it doesn't pay off most of the time. The VIX moves around every day, then all of these prices will move with it, but generally, futures are in contango, meaning they generally are going up over time the further away from the present date that you get. So if you buy one of these contracts, what will happen as time passes and they get shorter and shorter? Usually, they will go down. Here's a 5-year chart of the ETF VIXY, which buys VIX futures. You can see it spiked up over 200% in a short period of time in 2020. But even if you got lucky and bought it right before that, you would still be down 96% over the last 5 years. That's why the main component of SVOL is doing the opposite of that. They are shorting VIX futures. Here's what that strategy would look like if that was all you did. This is an ETF with the ticker XIV. It no longer exists anymore, but SVIX is a current version of more or less the same thing. It looks pretty much the opposite, right? Big steady increases, then short massive spikes down. I was buying a ton of this in late 2015 and early 2016 when people were so worried about the Chinese market slowing down. And I think there were headlines at the beginning of 2016. It was like the worst start to the market ever. And I just didn't see anything that really caused me to believe that we're about to have a zombie apocalypse or something like that. So I was buying, betting on volatility to go back down. Then it sold through mid to late 2016. I made a very healthy profit, but then I watched it triple after my final sale in December. I was kicking myself, trust me. But you know why I sold? Because the VIX was at like 10. And what happens if you own a position that is supposed to do the opposite of the VIX? Well, if the VIX goes up 100% in a day, your ETF should go down 100% in a day. And 20 really isn't that high for the VIX. So I knew that that was actually likely to happen at some point. It was painful to miss out on all those gains, but what I feared would happen did eventually happen, and the ETF basically went to zero. Luckily, I no longer owned it at that point. So, is there a way to capture that consistent upside but limit the risk of those rare downside spikes? SVOL tried to do just that with 4 ways to limit risk. First, they short VIX futures, but only with 0.2 to 0.3 times leverage, meaning what the opposite of being leveraged. They only have about a quarter of the exposure to shorting VIX as the ETF I just showed you. That means that tripling in a year is pretty much off the table, but losing everything in a day probably is too. Then, on top of that, they don't maintain a set exposure to the VIX. Sort of like how I sold my XIB position when the VIX was too low because it meant the risk was higher. They sell longer term futures when the VIX is low because the risk is higher. So when the VIX is high, they usually sell futures of the second month contract, which would be the December one right now, because that's where they get the best risk reward historically. And when the VIX is high, it will usually come down. So they want to capture the upside when it does. When the VIX is low, they short futures 4 to 6 months away instead. That reduces the income they'll get, but it also greatly reduces the losses when the VIX spikes. Going back to our VIX chart, you can see that generally when the VIX spikes, it doesn't spike for that long. So when some big market event happens, a lot more people bet on the market to go down in the short term than the long term. When that happens, the VIX futures usually go into backwardation, which means that they go down over time instead of up over time. That happens because all the futures prices go up, but the short-term futures go up the most. So imagine you're shorting big futures like SVOL does in normal times, which is represented by the blue line. Remember, you're short futures, which means you're betting on them to go down. Then there's a market sell-off and the VIX curve goes up to the red line. No matter which VIX futures you had shorted, you'd be losing money because all the VIX futures across the curve were going up and you had been betting on them to go down. But the further out your futures are, the less the prices will move in general. That means that shorting futures further away reduces the risk of big losses during those VIX spikes. It also reduces the income you receive, but this is a key risk mitigation strategy that SVOL uses to limit losses. When volatility is low, and thus the odds of a big spike and big losses are higher, they take some of the risk off the table by shorting futures that are further away and thus have lower risk. The third strategy they use to limit risk is to buy hedges like VIX call options or stock market put options that are way out of the money. A VIX call option would pay off if the VIX spikes, and a stock market put option would pay off if the stock market falls, both of which generally happen at the same time. So let's imagine they own a VIX call option with a strike price at 40. The VIX almost never goes over 40, so it wouldn't cost much. But if it did go over 40, then beyond that point, their short VIX positions would be losing money, but their long VIX call option would be making money, offsetting those losses, or basically capping their losses. These are cheap because they rarely ever pay off, so they only have to spend roughly 1 to 4% per year on those options, but they help protect against the worst case scenario. The fourth strategy to mitigate risk and also enhance income is buying income producing securities like short term treasury bills. They're only shorting the VIX with about 25% of their portfolio, right? So, where does the rest of that money go? Generally, to conservative bonds that not only do these produce income, but they also generally go up when the stock market is going down, so they help act as a natural hedge. SFOL tries to do two things: produce consistent income and keep its downside risk similar to the S&P 500. So let's see how it's done on income consistency, downside protection, and while we're at it, total returns. At first, they weren't trying to keep income consistent, but since mid-2022, they have been. Then they've done a pretty good job. Unlike most income investments, most of the return in SVOL does not come from income-producing securities. That movement down the curve as the futures price gets cheaper and cheaper over time, that is called the roll yield, but it's not really a yield, as in like a payout. It's just the return you get from time passing by. They use that return, in addition to the bond positions, to create an income stream, which is why they're able to keep it pretty consistent. They basically estimate what the long-term roll yield plus bond yield will be in their underlying investments and try to create a consistent, smooth income stream that can match that. Over time, they may have to increase it or decrease it a little here and there, like how they recently reduced it from 30 cents to 28 cents because they expect interest rates to be falling, but it should maintain a relatively consistent level over the course of time. When it comes to downside risk, you can see SVOL's price without the dividends fell right in line with the S&P 500 during the downturn of 2022. Of course, with dividends, it did significantly better. Since SVOL is paying out pretty much all of its return as income, you really can't expect its share price to go up over time if you're taking out all the dividends. And it hasn't. SVOL's price is down about 13% since inception, which is about a 3.5-year period where the S&P 500's price has been up over 40%. However, with dividends reinvested, it has actually produced a very competitive return with the S&P 500 in red and way better than most other covered call ETFs like JEPI in green and XYLD in light blue. Why? Because it doesn't cap the upside. So, how does this fit into a portfolio? Well, first, it generally goes up and down along with the stock market, and they're trying to keep the downside risk at a similar level to the stock market, so it should be viewed as a replacement of a portion of your equity or stock market exposure. For a long-term growth investor, I would think about this as a diversifier away from traditional stocks. Usually, when people diversify their stock exposure, they're thinking about growth versus value or US versus non-US. But if the markets are generally flat, none of those would be doing much. In that environment, SVOL would likely do better than most broad stock market indexes. So I see it as a way to further diversify your equity exposure with 100% of the dividends reinvested, of course. For an income investor, I think this is the best strategy I've seen to date. Here's why. Yes, they try to provide stable distributions, but they are not likely to increase over time. So if you've been paying attention to my channel, probably you're saying, wait, Ethan, isn't that your main concern with all these other covered call ETFs? Yes, but in this one, the upside is not capped. So it can do a much better job recovering from losses. The income may not rise, but it's also so high that I think you could use it to create a sustainable growing income stream. Here's how that could work. Let's imagine this was your whole portfolio. I'm definitely not suggesting anyone actually make this their whole portfolio, but just for illustrative purposes, let's imagine it was. SVOL has been paying around 15 to 17% income, give or take. And if you take out all of that as income, your income will not be sustainable and will fall over time. I'm confident of that. But if instead you reinvested all the income, but then created a systematic withdrawal plan where you took out something more reasonable, like, say, an 8% income stream from your account, and then increased those distributions every year to match inflation, I think you would have a way better chance to create a sustainable high income stream than with any of the covered call ETFs I've covered, like JEPI or JETQ. Just imagine. So the blue line is SVOL's returns without income reinvesting. The red line is its returns with all of the income reinvesting. If you started with, say, $100,000 invested in SVOL, and instead of taking all the dividends, let's say you took out an 8% annual yield, split up monthly. In 2022, you increased it along with inflation, then again in 2023, and again in 2024. You started taking out $8,000 a year, and now you're getting, $9,000 or something like that. This is all hypothetical. I'm not going to do perfect math. Well, first of all, your income would have been steady and rising along with the increasing inflation, so you wouldn't have lost any purchasing power. Second, you would have been reinvesting something like 6 to 10% of your income for about 3.5 years. So the value of your investment would not be down 13%. It would have still been growing. Obviously, it wouldn't have been growing as much as if you'd reinvested all of the dividends, but it would have been growing, while also giving you a high and growing income stream. Nothing is guaranteed, but like I said, I've been selling volatility for over a decade, so I have a pretty good sense for how it works over time and in different market environments. Given the risk mitigation techniques they have, I think they've built a really solid strategy for insulating this ETF from the most catastrophic tail risks. With shorting volatility, that's always been the only downside. It's always provided very consistent, solid, high upside returns. But then once in a while, you get crushed, like XIV did, which thankfully I didn't own when that happened. So since those risk mitigation techniques are in place, I think SVOL is designed really well to provide nice diversification from traditional equity exposure. And for income investors, if used responsibly, meaning not taking out all of the income, I think it can be a really useful part of a portfolio designed to create a high and sustainable income stream. If you found this video helpful, hit the like button, leave a comment with what you'd like us to cover next, and subscribe so you won't miss it. And if you'd like to connect directly with my partner Kyle and I, you can do so by joining our Discord through the link in the description below. We'll look forward to seeing you in the next video.